$1.7 trillion. That is not the GDP of some struggling developing country. That is the total amount of student loan debt sitting on the backs of 44 million Americans right now, this morning, as you watch this video. And last week, something changed inside that number. Something quiet. Something that the Department of Education buried in a policy memo that almost nobody read. A trigger was pulled, a fuse was lit, and the 44 million Americans who owe that money have absolutely no idea what is about to hit them. I'm going to show you exactly what happened, exactly what it means, and exactly how it cascades from a bureaucratic policy change into the most disruptive financial event in the lives of an entire generation of Americans. Not in 5 years, not in 2 years. The first wave hits within months. The second wave is already in motion. And by the time the mainstream financial media connects these dots, the damage will already be done. So stay with me. Because what I am about to walk you through will change how you think about your own financial position, whether you have student loans or not. Before we go any further, if you're new here, hit subscribe right now and turn on the bell. We cover the economic stories that get buried under the daily news cycle, and I promise you, this one is not getting the coverage it deserves anywhere else. And I want to ask you something directly. Drop a comment right now and tell me where in the world you're watching this from. Whether you are in the United States dealing with student loans yourself, or you are in the UK, Canada, Australia, Europe, watching this from the outside, looking in at the American debt crisis, tell me your location in the comments. I genuinely read them, and I want to see how far this community reaches. Type your city and country right now, and while you're down there, tell me, do you have student loan debt, or do you know someone who does? Yes or no? Let us see the numbers. To understand why this moment is different, why this is not just another news cycle about student debt that fades in 3 days, you need to understand how we got here, because the history of this crisis is the story of the most successful financial trap ever constructed around a generation of people who were told they were doing everything right. Let us go back to 1965. That is when the federal student loan program was created under the Higher Education Act. At that time, the average cost of a 4-year college education at a public university was roughly $400 per year. Adjusted for inflation, that is about $4,000 in today's money. A student who worked a part-time job could realistically pay for most of their college education without borrowing. The system made sense, the debt was manageable, and for about 20 years, it worked reasonably well. Then, something changed in the 1980s. State governments began systematically cutting their funding for public universities. The federal government, rather than replacing that funding directly, expanded the student loan program instead. Universities, suddenly freed from the constraint of state funding and armed with a seemingly unlimited pipeline of federally backed loan dollars, began doing what any institution does when the constraint is removed. They spent, they built, they hired administrators, they expanded programs. They competed for rankings by building amenities, luxury dorms, athletic facilities, dining halls that looked like restaurants. And every year they raised tuition, not by 2 or 3%, by 7, 8, 10% annually, year after year after year. Between 1980 and today, the average cost of a 4-year college education has increased by over 1,300%. That is not a typo, 1,300%. During the same period, the overall inflation rate was about 350%. The median household income grew by approximately 400%. College costs grew at more than 3 times the rate of everything else in the economy. And because the federal loan program had no meaningful limits on borrowing, because a student could borrow essentially whatever the university charged, there was no market mechanism to push back on tuition increases. The universities raised prices, and the loan program absorbed the increase every single time. The result, 40 years later, is $1.7 trillion in outstanding student loan debt, 44 million borrowers, an average balance of approximately $37,000 per borrower. But the average masks the reality at the extremes. Graduate students, medical students, law students, MBA graduates from private universities are sitting on balances of $100,000, $200,000, $300,000. And unlike every other form of consumer debt in America, unlike credit card debt, unlike personal loans, unlike even income tax debt, student loan debt is almost entirely non-dischargeable in bankruptcy. You cannot escape it. You cannot walk away from it. It follows you to your grave. Now here is where we get to what just changed, and why this moment is the one that lights the fuse on everything that has been building for 40 years. During the COVID pandemic, the federal government implemented a student loan payment pause. Starting in March of 2020, all federally held student loan payments were suspended. No payments required, no interest accruing. For 3.5 years, 44 million borrowers did not have to send a single dollar to their loan servicers. The government extended this pause 8 separate times under 2 different administrations. It became one of the longest-running emergency financial relief measures in American history. Then, payments resumed. In October of 2023, the Biden administration ended the payment pause, and borrowers were required to start paying again. But here is what the headlines did not tell you about what happened next. The resumption was a catastrophe. In the first quarter after payments resumed, the student loan delinquency rate, the percentage of borrowers who missed at least one payment, was running at approximately 40% among borrowers whose loans had entered repayment, 40%. In any other loan category, a 40% delinquency rate would trigger emergency intervention from every financial regulator in the country. For student loans, it was treated as an expected transition challenge. The Biden administration responded by rolling out an income-driven repayment plan called SAVE, Saving on a Valuable Education, which was designed to reduce monthly payments for lower-income borrowers and provide a faster path to loan forgiveness. Millions of borrowers enrolled in SAVE, millions more enrolled in older income-driven repayment plans. The payment amounts under these plans were often dramatically lower than what the underlying loan balance would require under a standard repayment schedule. Some borrowers on income-driven repayment were making payments of $0 per month, meaning their balances were not shrinking. They were growing as interest continued to compound. And then the current administration came in, and everything changed at once. The SAVE plan was challenged in federal court. Multiple courts issued injunctions blocking the program. Millions of borrowers who had enrolled in SAVE were suddenly in legal limbo. Their repayment plan frozen, their payment amounts uncertain, their path to forgiveness in question. At the same time, the new administration made clear its position on student loan forgiveness. It is not coming. The broad forgiveness programs that millions of borrowers had been counting on, including the income-driven repayment forgiveness tracks that promise cancellation after 20 or 25 years of payments, are being challenged, restructured, or simply defunded. And now, the policy memo that nobody read. The Department of Education has quietly initiated a process to restart aggressive collections on defaulted student loans, including a tool that has not been used in 5 years, and that most borrowers have completely forgotten even exists. That tool is called Treasury Offset. And it is one of the most powerful debt collection mechanisms in the United States government's arsenal. Let me explain what Treasury Offset means, because this is the specific fuse that just got lit, and this is the part that 44 million people are not thinking about. When a federal student loan goes into default, typically after 270 days without a payment, the Department of Education has the legal authority to refer that debt to the Treasury Department for collection. And the Treasury Department has the authority to intercept without any prior court order, without any additional legal process, without any advance notice to the borrower, virtually any payment that the federal government owes you, your federal tax refund, seized, your Social Security benefits if you are a retiree with defaulted student loans, garnished, your federal wages if you work for any agency of the federal government, intercepted, all of it, legally, automatically, with no judicial review required. Before the pandemic, approximately 9 million borrowers were in default on their federal student loans. During the pandemic payment pause, the government suspended Treasury Offset. Those 9 million people kept receiving their tax refunds, their Social Security payments, their federal wages. For 3.5 years, the collection machinery was mothballed. Now it is being restarted. And the population of borrowers who are now at risk of Treasury Offset is not 9 million. It is estimated to be between 10 and 12 million borrowers who are either already in default or who have fallen into what the Department of Education calls severe delinquency, behind by more than 90 days since payments resumed. For millions of Americans, the first notification they receive that their student loan situation has reached a crisis point will not be a phone call or a letter giving them time to respond. It will be the discovery in February or March of next year that their federal tax refund, money they were counting on to pay rent, to cover medical bills, to repair a car, is simply gone, intercepted, applied to a student loan balance they may not even have fully understood was in default. That is the fuse. That is what just got lit. Now, here's the first hidden layer on top of that. The student loan servicers, the private companies contracted by the Department of Education to manage billing, payments, and communications for federal borrowers, are in crisis themselves. 3 of the largest servicers have either exited the federal loan servicing business or dramatically reduced their operations over the past 3 years. Borrowers have been transferred between servicers multiple times, often without adequate notice. When borrowers call to understand their repayment options, they face hold times of hours. The servicers are understaffed, undertrained, and operating on legacy technology systems that were not designed to handle the complexity of the current repayment landscape. The machinery of communication between the government and 44 million borrowers is broken, and a broken communication system means that millions of borrowers who would choose to enter repayment, who would choose a plan that keeps them out of default, simply cannot get through the phone lines to do it. The second hidden layer is what this does to the housing market. A borrower in default on federal student loans, or a borrower with a significantly damaged credit score from missed payments, cannot qualify for a conventional mortgage. The debt-to-income ratios required by Fannie Mae and Freddie Mac for mortgage underwriting treat student loan payments as fixed obligations, regardless of the repayment plan. A borrower with $100,000 in student loans, even on an income-driven plan with currently 0 monthly payments, faces a phantom debt calculation that effectively bars them from buying a home in most markets. The 44 million people carrying student loan debt are disproportionately concentrated in the 25 to 45 age range, the prime first-time homebuyer demographic. The student loan crisis is one of the primary structural reasons why homeownership rates among millennials are historically low, and why the housing supply crisis in America has a demand component that nobody talks about. Millions of people who want to buy homes cannot qualify because of student debt. As the collections crisis intensifies and credit scores are damaged further, the population grows. The third hidden layer is what this does to consumer spending, and therefore to the broader economy. 44 million borrowers resuming meaningful loan payments is not an abstract macroeconomic event. It is a specific, calculable reduction in discretionary spending. The average student loan payment under a standard repayment plan is approximately $460 per month. Across 44 million borrowers, that is $20 billion per month, $240 billion per year. That is redirected from consumer spending into debt service. That money does not go to restaurants. It does not go to retail. It does not go to vacations or cars or home improvements. It goes to the Treasury Department. $240 billion per year extracted from the consumer economy. And the Federal Reserve, which has been trying to slow consumer spending to fight inflation, has not fully accounted for the student loan payment resumption as a contractionary force in its models. The economic slowdown that is coming from this particular direction is larger than most forecasters are currently calculating. Let me bring this out of the policy world and into your specific life, because I want you to understand this concretely, not abstractly. If you are between 25 and 45 years old in America, the probability that student loan debt is affecting your financial life right now, directly or through a partner, a spouse, or a family member, is extraordinarily high. This is not a crisis happening to other people. This is the defining financial feature of an entire generation. If you are among the 44 million borrowers, here is your specific risk exposure in the coming months. If you're currently in default and you receive a federal tax refund, do not assume that money is coming to you this filing season. If your loan servicer transferred your account in the last 2 years and you have not confirmed your current status, you may be in a delinquency situation you do not know about. If you enrolled in the SAVE plan and received a notice that your plan was administratively frozen due to litigation, you are in a category of several million borrowers whose payment obligations are genuinely unclear and whose servicers cannot give consistent guidance because the legal situation is still being resolved in the courts. If you are not a borrower yourself, but you live with one, work with one, or are in a financial relationship with one, understand that a sudden discovery of a seized tax refund, $3,000, $4,000, $5,000 intercepted without warning, is a financial shock that can cascade. Missed rent, delayed car repairs, unpaid medical bills. The secondary effects of that shock ripple through households and local economies in ways that a line item in a policy memo does not capture. If you're a business owner who serves the 25 to 45 demographic, a restaurant, a retail shop, a service business, the resumption of full student loan collections is a direct hit to your customer base's disposable income. The spending pattern of your customers is about to change. The bills they were deferring are now coming due simultaneously. And if you are an investor, understand this: the consumer credit quality of the millennial generation has been artificially elevated for 3.5 years by the payment pause. Credit scores that should have been reflecting the strain of student loan obligations were not, because no payments were being missed. As collections resume, as defaults are formally recorded, as Treasury Offset begins intercepting refunds, and the credit reporting implications flow through, you are going to see a credit quality deterioration event in a specific demographic cohort that the consumer lending market is not fully pricing yet. History gives us some guidance on what happens when a large deferred debt obligation is suddenly reactivated across millions of borrowers simultaneously. The closest analog is not a perfect comparison, but it is instructive. In the early 1980s, when the Federal Reserve under Paul Volcker raised interest rates aggressively to break inflation, variable rate consumer debt that had been manageable at low rates suddenly became crushing at high rates. The household sector simultaneously contracted spending, defaulted on loans, and drove the economy into recession. The mechanism was different, but the core dynamic was the same. A large population of borrowers facing payment obligations they had not fully accounted for, all at the same time. The student loan situation has one feature that makes it more dangerous than the 1980s analog. In 1982, borrowers who could not afford their payments could file for bankruptcy and discharge most of their consumer debt. The bankruptcy code provided a genuine escape valve that limited the total damage any individual could sustain and allowed economic recovery to begin faster. Student loan debt, as I said earlier, is almost entirely non-dischargeable. There is no bankruptcy escape valve. The debt is permanent. The collection is permanent. The impact on credit, on spending capacity, on housing eligibility, it is permanent unless the underlying debt is paid off or forgiven. And forgiveness, as we have now established, is not coming in the current political environment. What that means is that the economic drag from this crisis does not resolve the way the 1980s consumer debt crisis resolved. It does not have a natural endpoint where the debt is discharged, the slate is cleared, and consumer spending recovers. It compounds, it persists. It follows a generation of Americans through their prime earning and spending years and suppresses the economic activity those years would otherwise generate. Here is what the government is not telling you about the true state of this crisis. The official student loan default rate, the number that the Department of Education publishes, has historically been calculated using what is called the cohort default rate, which measures defaults only within the first 3 years of repayment. This metric was designed decades ago when most student loans were much smaller and most borrowers could resolve a default relatively quickly. It dramatically understates the true extent of long-term default and distress in the student loan portfolio. Independent analysts who have looked at the full loan portfolio data have estimated that the true long-term default rate, the percentage of borrowers who will never fully repay their loans under any realistic scenario, is between 40 and 50%, not for the whole portfolio. But for the subset of borrowers who attended for-profit colleges, who borrowed for graduate programs that did not increase their earnings, or who borrowed during periods when their life circumstances, job loss, medical crisis, family emergency, prevented consistent repayment. Nearly half of those borrowers, by some estimates, are in a position where the loan is functionally never going to be repaid. The government simply keeps adding interest, keeps extending repayment timelines, keeps restructuring plans, and the balance keeps growing while the underlying obligation never resolves. The Department of Education's own internal actuarial analyses that have been obtained through Freedom of Information Act requests and reported by investigative journalists, show that the federal student loan portfolio is expected to generate net losses, not net gains for the Treasury. The student loan program, which was sold to Congress and the public as a profitable investment in human capital that would generate revenue for the government, is actually a money-losing operation when the real default rates, the real repayment rates, and the real cost of income-driven repayment forgiveness are properly accounted for. The taxpayer is already on the hook for hundreds of billions of dollars in implicit losses that have never been fully disclosed in the official budget. So what do you do with this? Let me give you specific, actionable information, because panic without a plan helps nobody. If you have federal student loans, the single most important thing you can do right now, today, is log in to studentaid.gov and check the status of every one of your federal loans. Not your servicer's portal, the federal government's own system. Find out whether any of your loans are in default. Find out which servicer currently holds your loans. Find out your current repayment plan status and whether any of your income-driven repayment plan enrollment is showing a frozen or pending status because of the ongoing litigation. Know your exact situation before the collections machinery starts moving. If any of your loans are in default, understand that the federal government offers programs called loan rehabilitation and loan consolidation that can bring a defaulted loan back into good standing. Loan rehabilitation requires 9 consecutive on-time payments and, upon completion, removes the default notation from your credit report. Loan consolidation is faster, but does not remove the default from your credit history. Both options stop Treasury Offset from applying to your future tax, refunds, and federal payments. But both options require you to act before the intercept happens, not after. If your loans are current, but you're struggling to make payments, income-driven repayment plans, even in their current legally uncertain state, are almost certainly still the right direction to investigate. The litigation over the SAVE plan specifically does not affect other income-driven plans like IBR, income-based repayment, and pay as you earn. These plans cap your monthly payment at a percentage of your discretionary income and can meaningfully reduce your monthly obligation if your income does not support the standard payment amount. If you are a parent who took out Parent Plus loans to finance your child's education, your situation is particularly urgent. Parent Plus loans have historically had more limited income-driven repayment options than direct student loans. The borrowers who face the most severe financial stress from the current policy changes are disproportionately older borrowers on Parent Plus, people in their 50s and 60s who are now facing loan collections at a stage of life when their income is fixed, when Social Security garnishment is a real possibility, and when the financial flexibility to absorb a sudden payment obligation is lowest. If you have no student loans but you have a child approaching college age, everything in this video is a blueprint for what not to do. The federal loan system is not the neutral, benign resource it was marketed as. It is a mechanism that transfers the financial risk of rising tuition costs entirely onto the borrower, with no ability to discharge the obligation, with interest rates that compound relentlessly, and with collections tools that have no equivalent in any other form of consumer credit. Every dollar your child can avoid borrowing, through merit scholarships, through choosing a lower cost school, through community college for the first 2 years, through work-study programs, is a dollar that does not spend the next 20 years collecting interest and limiting their options. Pull back for a moment and look at the bigger picture, because the student debt crisis does not exist in isolation. It is one thread in a much larger fabric of structural financial stress that is tightening simultaneously across the American economy. You have a housing market where first-time buyers are locked out by a combination of high prices, high mortgage rates, and the student debt overhang on their credit profiles. You have a consumer spending economy that is being squeezed by the simultaneous resumption of student loan payments, the ongoing elevation of credit card debt to record levels, and the persistent post-pandemic inflation in essential costs. You have a federal budget where the interest expense on the national debt has now surpassed defense spending, limiting the government's fiscal flexibility to respond to any new crisis. And now you have the reactivation of the most aggressive debt collection machinery in the federal government's arsenal, pointed at 10 to 12 million Americans who are already in financial distress. These pressures are not happening sequentially, one after another, with time for recovery between each shock. They are happening simultaneously. And the population absorbing the greatest concentration of these pressures, the 25 to 45 age cohort, the millennials and older Gen Z who carry the student debt, who are trying to buy homes in the worst housing market in a generation, who entered the workforce during either the 2008 financial crisis or the 2020 pandemic, who have had structurally lower wealth accumulation than any prior generation at the same age, this population is running out of financial cushion. The generation that was told that education was the path to financial security is the generation that the financial system has most systematically extracted value from. They paid inflated tuition for degrees using debt that cannot be discharged. They entered a job market devastated by the worst financial crisis since the Depression. They were locked out of housing appreciation because they couldn't buy homes during the years of low rates. And now, as they approach their peak earning years, the collection machinery for the debt they took on as 18-year-olds is being fully reactivated with no safety net, no political will for relief, and no judicial escape route. The $1.7 trillion student debt bomb has always been sitting there. Everybody knew it was there. The politicians knew it was there. The economists knew it was there. The universities that kept raising tuition knew it was there. The servicers charging fees on every payment knew it was there. The hedge funds that bought securities backed by private student loans knew it was there. Everyone who benefited from the inflation of this bubble knew it was there. What just changed is that the fuse got lit. The protection mechanisms, the payment pause, the forbearance programs, the income-driven repayment plans, the administrative forgiveness pathways are being dismantled one by one. The collections machinery is being reactivated. The Treasury Offset program is coming back online. And the 44 million Americans who owe this money are in large part only now beginning to understand that the safety net they thought was under them has been pulled away. The economic consequences of this for consumer spending, for the housing market, for credit quality in the millennial cohort, for the retail and service businesses that depend on discretionary spending from that demographic, are not priced into the current consensus economic outlook. The mainstream forecasters are not modeling a Treasury offset shock affecting 10 million borrowers simultaneously. They are not modeling the second-order effects of 44 million borrowers redirecting hundreds of dollars per month from spending into debt service. These effects are real, they are calculable, and they are coming. The borrowers who understand their situation, who check their loan status now, who explore their repayment options now, who take the steps available to them before the collection machinery engages, are in a fundamentally different position than the borrowers who find out what happened when they check their bank account after tax season and the refund is not there. Information is the only leverage you have against a system this large and this powerful. You now have the information. What you do with it is the only variable left. I want to hear from you in the comments. And I mean a real, substantive conversation. This topic deserves it. Tell me where you're watching from. I asked at the very beginning, and I genuinely want to see the map of this community. And then tell me this. Do you have student loan debt, or do you know someone who does? Tell me what your situation is. Have you already dealt with a servicer transfer, a frozen repayment plan, a missed notice? The comment section of this channel is one of the best places on the internet to get real information from real people going through real financial situations, not sanitized advice from someone trying to sell you something. So let us have that conversation. Drop your location, drop your situation, and let us actually talk about this. If this video gave you information you think someone in your life needs, a friend with student loans who has not checked their status recently, a family member on a Parent Plus loan who does not understand the collection risk they are facing, a young person who is about to take out loans and needs to understand what they are actually signing. Share this video with them today, not eventually, today. Because the window to act, to check status, to enter a repayment plan to avoid Treasury Offset, that window is not unlimited. The machinery is already being reactivated. The earlier someone knows, the more options they have. Subscribe if you're not already here and hit the notification bell. We are going to be tracking this story in real time. Every court ruling on the Save Plan litigation, every Treasury Offset restart update, every servicer communication, every piece of data on default rates and collections activity. You will get it all as it develops, before it becomes a crisis moment for the people you care about. 44 million Americans have no idea what just happened. You are not one of them anymore. Stay informed, stay prepared, and I will see you in the next one.